Hello there and welcome to another casual valuation. This time it's Dropbox and it is a company that comes as a suggestion from one of the subscribers, so thank you very much for that. And let's get started. Now the first thing that I normally want to do is take a look at the chart, the share price movement, to see if there's something that looks a bit odd or how the company just performed through the share price. Now, as you can see, I've chosen here the maximum amount of time for which share price is available. But actually, if I was to choose a 5-year one, it's exactly the same because the Dropbox is not public for that very long period of time. And the return is not great, down 24% since the first day of trading. The IPO price was actually $21 a share. So if you bought it at that moment, now roughly 5 years later, you would have had a little bit less than $1 gain. The market cap is 8 billion and I want to round it to 8 billion so that later we can use it and make some comparisons to this number. And the share price, as you can see, was kind of fluctuating around this level between say, $18 and $30 a share. And there isn't really a huge spike in any direction that was sustainable. It's not that it went up and it remained there for a year or two. It's been not as volatile as a lot of other companies. What I'm a little bit surprised is that it didn't have a huge spike here around COVID. And we're going to take a look into that through the fundamentals, of course. There's something that I find a little bit interesting, and that is all these buy or sell side analysts, when they're analyzing a company, if it's a buy side analyst, if it's somebody who's really bullish on the company, that person tends to ignore all of the risks. If it's a sell side analyst, that person tends to ignore all of the positives and something that can really turn out to be important in the long run for the company. And I want to cover both of them. So I want to focus on both the negatives and the positives throughout the video. But first of all, what is Dropbox? Well, in a nutshell, it is a cloud storage solution where you can store your content and share it with others and also access it from everywhere. And this would have been revolutionary 20 years ago, and it was. But today, I mean, we take this for granted because so many companies offer something similar. And I mean, I've noted the big ones on the bottom of the screen. Those are ones that are in this market. They're Dropbox's competitors. So we cannot ignore that. So that is something that we need to keep in mind, that they can't just raise the prices over time as much as they want, because if they do, well, switching is not that difficult, right? Taking the files and moving them somewhere else is not that difficult. And in order to compete with them, they have to come up with something different. And of course, it's difficult because all of these other companies are doing exactly the same. They have Doc Scanner, an app that allows the user to scan a hard copy document and convert it into a PDF. Of course, that uses a lot of machine learning and artificial intelligence. And in 2019 and 2021, they acquired two companies to strengthen their product portfolio, HelloSign and DocSend. And they're again related to I'd say, improving the usage and the sharing and the signature around documents. So it's within this same field. But if we take a look at the big picture, it's all about users, right? It's a subscription-based service. So if Dropbox wants to grow, they need to have more paying users and they need to increase the average revenue per user. Now, the average revenue per user, that's something that it will be difficult to keep increasing, mainly because of the competition. So a lot comes down to the number of paying users. If you take a look at the total user base, that's over 700 million. This is what the bullish analysts focus on. There are 700 million users. Imagine, this is a key point, imagine if this number of users from 17 million, right, grows significantly. Imagine, and a higher portion of the 700 million become paying users. Imagine. That is one of the theses. But it's about imagination and it's about trusting that Dropbox can convert these users from free to paid users. At the moment, 2.5% of all the users are paying users. I am one of the other 97.5%, one of the freeloaders. And I think that majority don't really have, don't see the value in going into the premium packages. Me as well. I mean, 2 gigabytes that they offer for free is more than enough for the purpose that I'm using Dropbox. And imagine that there are a lot of people, right? Imagine that are just using Dropbox to store some old photos and they will not touch them and they will not view them in the next 5 years, and then maybe they'll come back and want to remind themselves of the nice memories. They're not going to pay monthly for the 5 years. Why should they? When they can just store them for free, and then when they log in 5 years later, they get a push notification that they can just dismiss. So if you take a look at the imagination side, right? On one side, you have the bullish analysts that are kind of imagining larger portion of the users becoming paying. And on the other side, there's the sell side that are just really bearish on the conversion and the maybe the ability to convert of Dropbox, especially today when there are a lot more alternatives than before. So this is kind of one thing to keep in mind, and you can put yourself in one of the two categories and you can think of which side are you on. Do you believe, because this is very important, this is the starting point. If you don't believe that Dropbox can convert more users, then you would not be optimistic about the company. And if you're not, then investing in a company that you don't trust is something that will not help you to sleep at night. So this is a starting point, and I think it's relevant. Now let's zoom out and let's take a look at the financials. The revenue has been growing. Of course, the paying user has been growing. The average revenue per user has been growing. So 2018, a bit below 1.5 billion. Now it's over 2 billion. And at the same time, the gross margin improved. So what is between the revenue and the gross profit? That is actually all the expenses related with the storage, delivery, and distribution of the content of the platform. But it is not only for the paying users, that is also for the free users. So the free users are spending no money, but Dropbox is spending money to keep their content there, to store it, and to provide the service. So keep that in mind, that the free users are free from their point of view because they can access the platform for free, but the Dropbox has to spend money to keep them on the platform. And then we have the second part, the chart below, which is the various kind of operating expenses that they have been improving over time. And you will notice that I've added the last 4 full years, the last 12 months, which is just 1 quarter different compared to 2021. And there is this target. And that is something that they have as in their investor presentation. That is where they aim to get in the long run. And you'll notice that, for example, the R&D significantly decreased as percentage of revenue from 55% down to somewhere around 33%. And it's actually quite close to their target, which means they don't see a lot more operating improvements, or they're expecting that they will not grow as fast. Sales and marketing decreased, but again, it's getting to a point to their long-term target, and it's difficult to forecast further improvements. General and administrative, exactly the same. Of course, if this target was set back in 2018, we would have seen that they have a long way to go. But now in 2022, it's quite clear that they are getting there. Now, they had this other charge, which was significant, 20% of the revenue in 2020, and that is related to an impairment. And I wouldn't focus too much on this because the significance is not really that much. It's not cash movement, but it is related to certain assets, real estate, and operating leases as a result of their decision to shift to being a virtual first company, so working from home basically or remotely as the main option, and therefore the value of the real estate in use is lower because it's not being used as much. Same goes for the operating, everything that's operating lease, or they have through an operating lease. So if we take a look at the operating margin, so if we take the both the direct costs and all of these operating expenses, we do see this improvement. 2018 minus 35%, improved over time. Now it's close to 15, 16%. That is the operating margin. But take a look at the revenue. Yes, it seems as it grows. So it grew 19%, then 15%, then 13%. And at this time, they also did two acquisitions that is basically is supposed to help them grow the average revenue per user. So without those acquisitions, the growth would have been much lower, but it's also declining over time. And where is COVID-19? I mean, I would have imagined that when a lot of companies are moving from the traditional office way of working through the remote way of working from home, I would have expected that Dropbox is one of the companies that benefits from that. I don't see it in the revenue. Where's the conversion from free to paid users? If they can't do it now in these times, I mean, how are they going to do it? I just don't see it. And this is what makes me a little bit more pessimistic about the conversion. And of course, you can disagree with me, but this is kind of my view of the conversion cycle. Now, I want to take a look at the balance sheet before we move to the cash flow. It is relatively simple. Basically, of course, they have an increase in cash flow, 400 million over kind of 3 years and a quarter. Of course, 2018 in this slide is my starting point, 31st of December. So we have 1 year until end of 19, another one end of 20, another one until the end of 2021, and the last 12 months is as of Q1 2022. So there isn't really a lot. They have grown the cash flow. They've increased the property, plant, and equipment, but that's because of the new standard on lease recognition. And we have here the two acquisitions that they do. And we can notice that also by the increase of goodwill, right? 97 million to 234, and then to 356. So it could be that if they want to keep growing, they need to keep acquiring new companies. Of course, having users registered is great, but if you're not monetizing, if you're not acquiring companies that will be appealing to these users, the users are just burning cash. On the liabilities and equity, they increased their debt significantly, 1.4 billion 2021, but the cash increased for only 400 million. So actually a large part of this debt is just gone, right? We know that that from the asset side that the increase is not as much, so we need to figure out what actually happened. And they're engaging in share buybacks. If you take a look at the shares outstanding at the end of the period, 411 million to 372. So this change is roughly 10%. So if the market cap is 800 million, we can round it to like 900 million change in terms of the market cap due to the reduction of the shares outstanding. That is kind of the net movement. And they have 1.2 billion repurchase plan approved. What this means is that the management can decide to further buy back shares and spend up to 1.2 billion on that. Now, here's another big story, again from the bull side analysts, the bullish ones, regarding the company. And the numbers here come from the presentation that Dropbox provides. So the free cash flow was 400 million 2019, almost 500 2020, 700 in 2021, and it's expected to reach 1 billion by 2024. This is the big topic that we really need to address. And if you think about it, if a company has 1 billion free cash flow and just pays it out to the shareholders, the market cap today is roughly 8 billion. So that means that's a yield of 12.5%. So if the free cash flow is not even growing and they just keep distributing it back to the shareholders, that should be 12.5% every single year return, right? Well, not really. And the reason why that's not the case is we need to understand what free cash flow actually means. The formula is actually quite simple: operating cash flow minus capital expenditures. But it's a little bit more complex. if you think about it, the whole purpose of free cash flow is to look through the lenses of cash. So what about the share-based compensation or the stock-based compensation? Those terms are interchangeable. It doesn't show anywhere. So think about it this way. If all the employees are paid through cash, the free cash flow will be lower because operating cash flow will decrease. There's a cash outflow. But if all the employees, in theory, are paid through share-based compensation, it will not be shown anywhere. Where it will be shown is in the shares outstanding because the existing shareholders will be diluted. But we don't see it in the free cash flow at all. So what free cash flow represents is this is the actual cash that the company will have remaining. And with that, what they will need to do is, what they can do is buy back shares. They can pay as dividends. They can acquire new companies. And you might say, well, wait a second. If they acquire a company, isn't that a capital expenditure? That's where one of the other tricks comes in. The capital expenditure based on the definition is when they make investments in their own business, in their existing part. If they acquire another company, that's not part of the free cash flow. And it's not that Dropbox is misleading us. This is just the generally acceptable definition of free cash flow. Because of course, the management can decide not to acquire any company. But when we look at the cash flow, it seems a little bit too good to be true, right? Because we have 1 billion. And I know that it's as of 2024, which is not that far from here. So even though it's free cash flow, we need to address these two topics, the stock-based compensation and the acquisitions. And let's take a look at the cash flow. Specifically, let's start with the stock-based compensation. Right, the way that every cash flow is structured is, first, we have this segment that ends with the cash from operation, right? That's the cash, the actual cash that they generated from their operations. Then there's the cash from investing, so everything investing related, and then there's the financing cash flow. And for every year, we can see these numbers and take a look at the stock-based compensation, 650 million. So in 2018, their net income was negative 500 million, but they generated cash of 360 million. Right? So we see a huge discrepancy there already. Operating margin last year was 16%. The free cash flow margin is 33%. So these two don't add up. Just they don't add up. There's something that we're missing and we know what it is. So if Dropbox is to spend as much money to maintain this share-based or the number of shares at the same level to prevent dilution, what we see here, 650 million, 260, 260, 290, 290, that's what they need to spend into buybacks. And one of the argument is, well, look at this. They are buying shares. 350 million, 1.2 billion. Like this is a huge amount, 500 million. But this part is nowhere in the free cash flow. So it's a little bit misleading if we assume that there's 1 billion remaining for us as shareholders. That's not the case. It's available for the management to decide what to do with it. So whenever you hear free cash flow, it's not free for the shareholders. It's free for the management to decide what to do with it because they don't have any pressure operations-wise. And what Dropbox's management decided to do with it, of course, if you take a look at the acquisitions, that's over 300 million in these 2 years, right? We know that they acquired 2 companies. So the free cash flow seems very nice, but we don't have it. And we won't have it in the future as well. So imagine 2 years, 3 years down the line, if the free cash flow is 1 billion. Well, it could be 1 billion, but if they want to prevent shareholders to get diluted, this share-based compensation will probably be 350. So they need to buy back shares at least of 350. So now the free cash flow gets much lower. We'll get to 650, or the cash flow that's left for us will get down to 650 million. But what if they have to, what if they want to acquire a company? to keep growing. Because remember, they acquired two companies and the revenue growth is declining. And if they want to get to that 1 billion, they need to keep growing. So the cash for us as investors will decrease. It will not be, it will no, like, I think the easiest way to show this is based on the assumptions later on to actually see what is the cash flow that actually is left for us as investors. And here's what the analysts are expecting. This year, about 8%. Next year, 6.6%. So again, we're looking declining revenue. 2024, it's expected that the net sales are 2.6 billion. And on this 2.6 billion, they expect to have 1 billion in free cash flow. Sure, based on that traditional metric, yes, but that's not the actual cash that remains for the shareholders. So this 12.5 yield, free cash flow yield, no, that's not real. That's not real for the shareholders. So my assumptions are the following: 7%, sure, let's assume that they grow at 7%, but I'm going to forecast acquisitions because they cannot grow 7% organically. We see that the growth is coming to decline. They had 2 acquisitions at a period of time with COVID that they should have benefited from, and during that time the revenue was declining. So if I'm to forecast the 7%, I'm definitely going to expect that they reinvest. If not, without the reinvestment, I would be even more conservative with the revenue. And you can play with, of course, with both of them. Operating margin currently is 15%. I expect it to be 22%. And this is way above the estimates. Why? Well, if we go back to the cash flow, what you'll notice is that the depreciation and amortization is quite significant. 160, 170 million, about the same 150. But if you take a look at this line, capital expenditure, 60, 130, 80, 20, it's much lower. So they don't have to reinvest as much in that because a lot of the reinvestment comes from the acquisitions. And if you want to double check the calculation for the free cash flow, don't forget that in order to get there, all you need to do is cash from operations, 425 million, and then subtract only this line, capital expenditure. So don't touch the cash acquisitions. That's not part of it. Again, it's a free cash flow, free for the management to decide what to do with it. So back to the assumptions. Because they're reinvesting less, they can replace their assets with less investments. The margin will increase because the future amortization and depreciation will be lower as percentage of sales. And also we have the amortization, for example, of intangible assets due to the acquisitions. That's also there. And over time, that will just be gone and, well, they'll acquire another company, but that is part of the reinvestment. And we have the weighted average cost of capital, so the discount rate, 6.7%, growing to 9.6% because of the environment that we are in. The debt, as you can see, it's quite low, 1%. It's not something that, of course, they got a big loan, but it's at a very good time. So for that, I think they did a very good job to time well when to get further debt. So take a look at the free cash flow based on the formula that I have, but that is after the share-based compensation has been kind of, they've bought back enough shares to offset the share-based compensation, and they did all the reinvestments, including the acquisitions. Free cash flow, it's nowhere close to the 1 billion, but this free cash flow is for us as shareholders. It is to the firm, but I'm subtracting debt, so it would be kind of the same thing. I'm expecting the revenue to grow, so that's 75% over the next 10 years. The earnings before interest and tax, I take the taxes out and all of these additional reinvestments. Here, it might seem, well, wait a second, you mentioned acquisitions, but 30 million, that seems quite low. Here in this segment, I leave the regular depreciation amortization, which was 150, 160 million already. So these 30, 40 are on top of that. And then what we get is, of course, the free cash flow. And if you take a look, of course, nowhere close to the 1 billion, but this is, I think, much more real picture of what we would get. Again, this is based on the assumptions that I have, and I could be wrong when it comes to the revenue growth or the margins. But it would look something like this. Present value of all of these future cash flows is this value of the operating assets. That is what it will bring, 7.1 billion. And that is, of course, the value of the business 10 years from now, the 3.6, and the cash that will be generated in the next 10 years. Again, I'm assuming that they're buying back shares, so the shareholders are not being diluted. Plus, we add the cash 1.5 billion, minus the debt 2.4 billion, minus the equity options of 650 million. Take a look at this number, 650 million. Basically, because of all of the share-based compensations that they did in the last years, today, if those options are being used, they will dilute the shareholders. We don't see them anywhere, but they are there. So we need to subtract that as well. So the value of equity is roughly 5.6 billion. So that's not close to the 8 billion. Divided with the number of shares, the value is a little bit under $15 a share. That's way below not only the current price, but I mean, imagine the IPO 5 years ago. So if you assume a little bit different assumptions, right? If you take a look at the revenue growth, and if you assume not the 75% that I have, if you expect that Dropbox will grow much faster because of the conversion of these users from free to paid, then you might be looking into a little bit of a different scenario. And of course, depending on the margin, if you expect that to expand even further, then, it might be even fairly valued. And to be honest, the way I look at it is, it's a tough company to invest in, because for me personally, because it's operating in an industry where it's quite competitive, for one. But on the other side, it could be an interesting one as a potential acquisition target. Now, of course, these big ones won't really have the reason to acquire it because they have their own solution. But for example, their Salesforce, maybe it would be an interesting target for them. And it might be appealing because, again, they have 700 million users. So unless Dropbox figures out a way to monetize them, they're just costing the money. If they do figure out, of course, then it's a different story. But until then, I will not be imagining what if they convert a significant portion, because this significant amount of free users was there last year and the year before and the year before that and the year before that. So until I see the proof that they're converting better, I don't see a reason to include that into my forecast. And that would be all regarding this video. Please let me know if you have any questions in the comment section below. And as always, I'll see you in the next one.